Have you noticed that prices for everyday items like groceries or home goods are still going up? I know I have. Why are we still seeing price increases? The supply chain issues, they're all mostly behind us. We don't have dozens and dozens of sea container ships waiting to be unloaded off the coast of California anymore. And the silicon chip shortage, that's behind us. So why are companies still raising prices? Because they can. That's the answer my friend Sam Rines of Corbu Research predicted almost a year ago. Today on Global Macro Update, Sam will explain why companies are continuing to raise prices even if it means they sell a little bit less product, how Middle America is catching up to the coasts, why the labor market is so strong, and at the end he has a few investing ideas for you. I'm Ed D'Agostino from Malden Economics. Thanks for joining us. So Sam, it's great to see you. Thanks for doing this again. I always enjoy getting you on Global Macro Update. You've been so spot on with your assessment of what's happening with the economy, especially when it comes to inflation and interest rates. And you wrap it around this acronym, POV. Can you explain what that stands for and what you mean by POV?
Yeah, sure. So POV is price over volume, right? And it's this all-encompassing kind of idea that when it comes to the current economy and when it comes to what corporations are really doing in the inflationary environment that we saw late 21, early 22, and into 23, what we've been seeing is corporations really choosing to increase their price of whatever good it might be, particularly those with pricing power, increasing the price of their goods and services, regardless really of what it does to volume, right? So it's the elasticity that they're beginning to find. And what they're finding is there was a lot more pricing power that the consumer was willing to take in a lot of cases than what they thought going into, say, 2020, 2021. All of a sudden, they're really finding that they can increase their prices. Volumes will stay flattish, maybe down a little bit, but they're increasing prices at, call it high single digits to mid-teens, and they're only having volumes go down 1 or 2%. And, when that happens, revenues go up, and businesses like revenues going up. And at the end of the day, it's a pretty positive thing for many of these.
So last year, the story was supply chains were broken, and eventually they'll resolve, and prices will start to come back down. And what you're saying is that that's not happening. Is that right?
Oh, yeah. It's not happening any way whatsoever. And I think this is really something that needs to be taken to heart by investors and probably the FOMC. And I'll give two examples of this. The first that I think is really interesting is Wingstop, right? It is not as though Wingstop should have pricing power. Right. There's no shortage of places to go get chicken wings with some sauce on them and take them home. Right. There's no shortage. You can just kind of in your head list off at least 5 places you know of, probably within 5 miles of where you live. But Wingstop saw their prices of wings increase by 50, 60, 70, 80% at points during 21 and 22. And it raised prices by 20, 25, 20, 30-ish percent, somewhere in there. And what's really intriguing about this is wing prices have collapsed in the last 6 months, and Wingstop's pricing has not gone anywhere, right? Their revenues have absolutely surged, and all of a sudden their margins are beginning to explode higher. There's very little reason for them to lower prices when the consumer is taking the price and continuing to buy their wings. So you get a much, call it fatter bottom line at a pretty easy thing, right? You come up with an excuse to raise prices. In this case, chicken wing prices have gone up. You raise your prices pretty significantly, and then you hold them there for an extended period of time, and you watch your bottom line explode. It's a pretty easy formula. And there's this idea that maybe 23 is the year that you begin to see these prices mitigate in some form or fashion. And recently we saw Smuckers, of all companies. I mean, it's Folgers coffee, it's Jif peanut butter, right? Things that you use every day. We saw, they came out with their earnings report and announced that, they had 14% in terms of pricing. They had minus 4% in terms of volume, right? So there's your price over volume right there. But then you get to their guidance for 2023. And they're looking at a 6% net sales gain. You're like, okay, that seems somewhat reasonable. I wonder how much of that's volume. It was really interesting when you dug into it. They said, well, it's going to be pricing as we expect the elasticities to produce lower volumes. So they are predicting 6% revenue growth on declining volume. So right there, you're probably between 8 and 9% pricing. Plus a 2% headwind that they said they would overcome on FX. So you're again sitting at low teens in terms of pricing from Smuckers.
Yeah. So Sam, is this strictly a matter of just trying to boost margins, or does the labor shortage play into this? I mean, and what I mean by that is, are companies saying, well, we can't hire as many people as we would really need to be able to produce the volume that we used to produce, so let's just stop trying and raise our price?
So not really. I mean,
Okay.
it's pretty easy, right? You install another machine if you're Smuckers to manufacture a little more peanut butter. It's not really a labor intensive. I mean, in some ways, it's a labor intensive process, but that's more on the agricultural side than it is on the producing of peanut butter. So I would say it's much less to do with labor, at least in the terms of, call it Pepsi, Kimberly-Clark. All of these staples companies, Smuckers, that are increasing their prices, and has much more to do with they can. And,
Interesting. Okay.
And it's a pretty easy way to get your revenues higher. Where I think you're hitting on something really, really important that's being overlooked is in terms of the services side, right? So restaurants, et cetera. If you look at something like a Texas Roadhouse, if you look at Cracker Barrel, they're basically saying that 2023 is 5 to 6% more in labor costs, and they're going to increase prices accordingly. It's really on the good side. It's more particularly the name brand goods that have pricing power. It's more of a we'll raise price because we can. In terms of the services side, it's we'll raise prices not only because we can, but because we have to in order to overcome the cost of labor going higher. So it's a combination of both, but I do think you need to split it, at least on a mindset basis, between what goes on in the goods consumer staple side of things and what goes on in terms of the services side of the economy.
So how does this all factor in for the Federal Reserve? Are they doing the right thing right now? Because you've been saying, look, we're going to have rate increases for the foreseeable future and beyond. 2 months ago, when everyone was saying we got the pivot, they're gonna lower rates by the end of the year, you were pretty steadfast in saying, no, yeah. You're looking at the wrong thing.
Yeah, there's kind of two parts to it, right? You can look at the inflation data and say, hey, look, it's decelerating, and it is decelerating, right? I mean, you're unlikely to see Pepsi, Smuckers, Coca-Cola, Kimberly-Clark, all of those companies put in as much pricing in 23 as they did in 22. That doesn't mean they're not going to put pricing in. So they're decelerating their price increases, but they're not going away. It's not as though they're going to zero. So instead of looking at the CPI and saying, or PCE and saying, oh, look, it's decelerating, this is a good thing for the Fed, they're going to pause. I mean, remember, we went through this last summer, right? The Fed was supposed to pause coming out of the summer, and we were going to see this great market rally. And that didn't materialize because inflation continued to move higher. I would say inflation in the system is much stickier than people anticipated, and people are anticipating going forward. That means I call it 25s for life, right? You're going to have 25 basis point incremental increases to the Fed funds rate until you see an actual break in inflation. And that break in inflation, call it the consumer inflation mechanism, is simply much higher than the Fed anticipated and much higher than Wall Street anticipated.
6 to 8 months ago, I think people would have been surprised by anyone saying we're going to have Fed fund rates at 5% plus. nobody would have believed you. That was very non-consensus. Now, what I was going to ask you is, do you think we'll get to the point where Fed fund rates have a six handle? But as we're talking, I'm thinking, geez, maybe do they keep going up to 7%? I mean, where do they need to go?
It's a difficult question, and it's a difficult question on two fronts. One, it's not really up to the Fed at this point where they stop. It's up to businesses and consumers in terms of where businesses and consumers stop. Right, we're finding where the pricing power can go, and until it's almost I call it getting smuckered. If you are looking to find how high your prices can go before the consumer really begins to push back, that's going to potentially be a while. Right? I mean, 2, 3, 4, 5% increases, on a grocery shelf, it's not necessarily that recognizable. It's really recognizable in terms of revenues for a company. So it becomes an equation where the Fed has probably already raised rates to the point where Smucker's isn't going to borrow an incredible amount of debt to put on additional productive capacity, and the consumer is not going to take out a bunch of debt to finance their lifestyle. But it's going to be an interesting equation in terms of how long can the consumer continue to have demand for products that are continuing to rise. And I mean, it's been a year where it's been pretty much all pricing all the time, and the consumer has just taken it. And companies are more than willing to continue to increase prices and see volumes fall 1 or 2%. I mean, it's just that simple.
Yeah, the consumer behavior is really interesting here, because we've sort of started out by talking about company by company, some examples of where prices are being passed along. But at the consumer level, it's everywhere, right? Like, they're getting it from every angle. What's the other side of this argument? At what point does the price discovery get so far from so many companies and then the consumers just break?
Yeah.
And what happens?
What happens is you begin to have a lot more choice in the system, right? You begin to have a significant trade down in terms of what you buy. You have much more buying of private label, and you have much less buying of, call it, brand names. And you're seeing a little bit of that, and you've seen a little bit of that over the past year, but you haven't seen anything that significant. I would say the first place you should see it is in call it the vacation and the leisure side of the equation. When you look at that in depth, and you look at something like a United Airlines or a Norwegian cruise line, right? They're doing the exact same thing as Smucker's, just with a different name, right? They don't have as much volume or passenger capacity as they had pre-COVID, but they're pricing well above pre-COVID, and they continue to push that pricing higher and higher, and consumers haven't pushed back on that. So until consumers push back on the things they really don't need, like a cruise, it's really difficult to say that there's too much pricing across the board and that consumers are really beginning to pull back. I mean, bookings for Norwegian cruise lines are above pre-COVID levels for this time of year. I mean, and the pricing is 13% above pre-COVID levels. So this is one of those equations where you should have it be something like leisure goes down first in terms of your consumption, then services, going out to eat, etc. Then you have goods switching. And you simply haven't seen leisure take a ding. I mean, there's a metric called RevPAR, which is revenue per available room, that hotels use predominantly. And what you've seen is the occupancy has been kind of meh. Pricing has been through the roof.
Yes.
So it's, again, those are the type of metrics that you should see decline meaningfully first. And you're simply not seeing it. And again, COVID had added a whole bunch of oddities to the system, one of which was revenge travel, and revenge business travel is just starting back up, and going to conferences, going to give talks. People are getting back on planes. They're going back to hotels for business. That probably now picks up China hasn't even reopened. There's a whole bunch of craziness that you're about to see that I think we can't necessarily just extrapolate pre-COVID trends and pre-COVID correlations to the current era.
So let's move over to the other big topic that you've been writing about that you were so early to and non-consensus. But again, I think people are starting to catch up to your thinking now. And that has to do with the labor market. It's been unbelievably strong. And yet it's a little confusing right now because we are hearing almost daily about tech layoffs, and then the next week you hear that unemployment rate is now the lowest that it's been, since anyone that's alive can remember. So it's really confusing, but you have a framework for understanding that as well. Can you walk us through that?
The framework is largely that tech doesn't matter. I kind of start off with that, and I called it last year. I actually think I coined it at SIC. I called it bread over Bridgerton. And the notion there was that a lot of tech companies that thought that they had a significant amount of pricing power simply did not, that there was a lot of competition. And Netflix just cut prices for a lot of the developing world. So, bread over Bridgerton remains alive and well. The other side of the coin is there were a lot of tech employees that simply weren't necessary and weren't necessarily there to be productive. They were there to cover up the fact that they were, these guys were pumping out monopoly type margins underneath the surface. So you could lay off a tremendous amount of people and not have a significant amount of damage to either your growth trajectory longer term or your bottom line, basically, would incrementally move higher. So there was a lot of room to wiggle there. It actually creates a pretty interesting scenario for tech coming out of this, which is leaner, meaner, and still growing. But there's also the part that VC and private equity played that I think has been overlooked far too much here, where there was a lot of money put into non-productive, non-earning companies that incrementally needed to advertise in order to generate revenues. And those companies, as soon as it became difficult on the margin to raise additional capital, found that their valuations were lower, found that their advertising budgets were cut first, then their people. And that really affected companies like Snapchat first, the least productive way to spend advertising dollars, Twitter second, and then Facebook and Google, the two best ways to spend advertising dollars, came last. And so you really saw the dominoes fall in a pretty specific order. And you'll probably see the dominoes go back the other way with Google and Facebook coming out first, and then Snapchat and Twitter last. But there's a significant issue when it comes to a lot of these revenues and a lot of these employees were tied to one another. And now you're beginning to see the consequences of higher interest rates there. But that's not the US economy. That is the West Coast and call it upper East Coast economy. And in the middle, which I call being caught in the middle of America is not seeing anything like the tech issues on the coast. Tech issues get all the headlines, but Middle America is seeing a semi-boom in terms of manufacturing, construction of new capital facilities, et cetera, that began before interest rates went higher. So they're not interest rate sensitive projects. And people are getting pay raises and feeling a lot better. So the middle of America is finally kind of getting their revenge on the coast, and it's kind of fun to watch.
Well, isn't this sort of catch up in some ways for people at the lower end of the wage scale? Because wages haven't kept up with the pace of cost of living for years. And so, you now can get a job. My understanding is even in the middle of America where if you were a line cook, you maybe were making $12 an hour and now you're making $18, maybe $20 an hour. Yeah. Isn't that just sort of bringing them to where they kind of need to be?
Yeah, it's the Walmart effect, right? When Walmart raised the minimum wage to $14, it wasn't raising the minimum wage of Walmart. It was raising the minimum wage of the United States. I mean, Walmart employs around 1 to 1.25% of the U.S. population. I mean, that is not a small amount of people. So when it said, our starting wage is $14, everybody in America that employs somebody at the bottom end of the wage spectrum is either going to have to pay $14 immediately, or they will have to play catch up over time in order to find an incremental employee. It's that simple. So Walmart raised prices first. They won't be the last, and it's going to continue moving higher over time. So that's an interesting one. But to your point on kind of what's going on with Middle America, you find something like a Tractor Supply, right? They're finally catching up in terms of people are getting money in rural areas. They're seeing their labor valued at a higher rate, and Tractor Supply is putting up blowout numbers. It's incredible to watch, and that is predominantly a store located in rural, or call it very ex-urban type areas. So that's one of the ways that I think you can look at it. And Cracker Barrel, which does not have many suburban or city-oriented locations, also having great numbers and being able to raise pricing. So yes, to your point, Middle America is playing catch up, and they will continue to play catch up as we move forward.
So Sam, I know you at Core Brew Research, you've built a portfolio to express your ideas, and it's proprietary. So I don't want to ask you for anything in specifics, but can you talk in general terms at all about how you invest around the framework that you've built?
Sure. So it's long only ETF based with a focus on liquidity. So it's a portfolio that is nimble and thematic is the idea, right? So when we begin to see something like Middle America outperforming the coasts, when we begin to see re-regionalization really take over in terms of bringing back supply chains closer to the United States, we look for ways to express that make sense. So minimizing exposure to tech initially was one of our plays, call it an equal weight type exposure to the S&P. But recently what we realized was the tech layoffs are probably a call it medium-term positive for tech in general in terms of their ability to put a higher bottom line on even reduced growth rates. So as they begin to trim some of the operating expense fat, they're going to be much fatter on the bottom line going forward. So we began to add back a little bit of tech exposure in a pretty unique way. And we've been long U.S. energy for a while, believing that would become and will continue to be something that is important not only to the U.S. but to Western Europe and our Asian allies as well, as we rejigger the global energy system. So yes, we do try to express our ideas in a fairly liquid manner, but also in a pretty direct manner.
Last question on investing. How do you feel about bonds, with your 25 for life line? Are you staying away from the long end of the curve? Do you like the front end, short-term treasuries, or do you not even bother?
So I do like the front end of the curve. Yeah. I think
I do too.
Being call it a 2 to 5 year type exposure is pretty unique at this point. You're earning 4.25 type percent, and being able to get some of the roll down off of that over time, and beginning to call it see light at the end of the tunnel in a year, give or take, is something pretty unique to this situation. It's been a long time since you could have a risk-free return that was that high.
Yeah.
So I do like the front end of the curve, and considering the strength of the consumer and how we see the economy playing out, I would say there's some pretty unique opportunities within corporate credit that are likely to emerge as we move through the summer and into the fall.
You can follow Sam Rines two ways. One way is to see him at the Strategic Investment Conference coming up in May, where I think we have you on an energy panel. And I've got to put a little bit more thought into how we structure that and who we have on the other side of the table from you. I wouldn't want to be that person. The other way is Twitter, at Samuel Rhines, correct?
A kind of softish landing.
Sam, always good seeing you. Thanks for joining us for this interview today.